Welcome back to Investing Talk Podcast.
Good to be back.
Today we are taking an in-depth look at a company making serious waves in autonomous delivery. SERV Robotics.
Yeah, they've been popping up a lot lately.
Exactly. So we've compiled a full analysis, recent financials, operational milestones, technicals, analyst forecasts, the works.
And the core question we're trying to answer, based on all that, is pretty straightforward.
Is SERV Robotics a good time to buy right now? That's what we want to figure out for you. Before we dive in, just a quick reminder, if you find this analysis helpful, please take a second to subscribe, maybe leave a comment.
Yeah, engagement really helps us out.
And hey, if there's a specific company you want us to look into next, just drop it in the comments below. We might cover it.
Definitely. Okay, so SERV Robotics, let's explore what the sources tell us. Foundational business, current valuation. Where should we start?
Let's start where we always do, the raw numbers. And wow, the numbers here are something else.
You mean the revenue growth?
Yeah, the top line revenue. We're talking year-over-year growth of, wait for it, 773%.
773%.
It jumped from just over, $207,000 in 2023 to $1.81 million in 2024. I mean, that kind of scaling usually gets investors very excited.
It is certainly eye-catching, no doubt about it. But we've got to immediately put that in context, right? Especially with profitability.
Right, because they're not profitable yet.
Not even close, actually. Their net losses deepened quite a bit, too, necking $39.19 million in 2024.
Ooh, okay.
But, the sources are pretty clear on this. They frame it as typical. It's a high-growth, innovation-heavy robotics company.
So heavy R&D spend, prioritizing scaling over profit for now.
Exactly. Research and development, deploying that fleet fast, that's the priority. Immediate profits aren't the game right now.
Okay, we hear that investment phase argument a lot, but are there signs in the sources that this cash burn is, efficient? Or is it just the standard line?
That's a fair question.
Because they're in a really competitive space. Low emissions, self-driving, food delivery robots. What's their edge supposed to be?
Well, the efficiency argument seems tied to their proprietary platform. The sources emphasize that. They've developed their own specialized robotics and delivery tech stack. Analysts are calling it a technological moat.
A moat, suggesting competitors can't just easily copy what they're doing.
That seems to be the idea. Gives them an early mover advantage in this specific autonomous niche. Plus, they're structured for reinvestment.
How so?
Minimal long-term debt.
Yeah.
And they don't pay a dividend. So basically, every dollar they get goes right back into R&D and growing that robot fleet.
Okay, so that 773% revenue growth is exciting, but it costs nearly $40 million in losses to get there. How long can they keep that up? What about financial stability?
Always the critical question with these growth stories. The sources say SERV Robotics reported a pretty strong liquidity position, $183 million in cash and equivalents.
$183 million. As of when?
As of June 30th, 2025. So end of Q2. And management states this gives them a financial runway through the end of 2026.
A runway through 2026.
Right.
Okay, compared to that nearly $40 million annual loss rate. Does that feel conservative? Or are they just buying time until the next funding round?
Well, if the burn rate stabilizes, big if, yeah. But if it stabilizes, that's maybe 4 or 5 years of cash. The sources frame it as essential, gives them cushion for strategic investments, weathering volatility while they hit these big deployment goals.
And those operational goals are really the heart of the investment case here, aren't they?
Absolutely. It's all about execution now.
Which takes us right to the operational side. What's the single biggest goal we should be tracking for them right now?
Without a doubt, it's hitting the 2,000 robot fleet deployment target.
2,000 robots. By when?
By year-end 2025. This is the key metric. It validates their whole rapid scaling model.
And how are they doing on that?
Seems like they're on track. They just announced deploying their 1,000th robot on October 6, 2025.
Okay, so halfway there, with about, a quarter left in the year. Seems ambitious.
It is. But hitting that 2,000 number is absolutely essential if they want to reach that projected $60 to $80 million annualized revenue run rate they're talking about for 2026.
Let's just quickly clarify annualized revenue run rate for listeners. It's not guaranteed revenue, right?
No, definitely not. It's important. Run rate basically means you take the revenue from a strong recent period, like a month or a quarter, and you project that out for a full year.
So it shows potential capacity if things keep going well.
Exactly. It's a forward-looking projection. But hitting that $60 to $80 million range, it completely hinges on getting those 2,000 robots deployed and working.
Okay. And that kind of scale needs increasingly smart tech, better efficiency? What strategic moves are they making to make sure the tech not only scales, but also, gets cheaper per delivery?
Right, because scaling is one thing, but unit economics are crucial, and this is where the Value Robotics acquisition comes in.
Yes, that was recent. October 2025.
Correct. Seen as a transformative move. The whole point is to advance their AI foundation models, specifically for last-mile delivery.
And the goal there is pretty audacious.
Extremely. Reducing delivery costs to just $1 per delivery.
Wow. Okay, let's pause on that. Human delivery is typically, what, $5, $6, $7, even $8 sometimes?
Easily, depending on distance and time.
So getting it down to $1 using AI, that's not just saving money, that fundamentally changes the economics for restaurants, for consumers, everything.
It's potentially a structural disruption, total game changer if they can pull it off.
Makes sense.
And sort of adding weight to that strategy, the well-known Silicon Valley investor Vinod Khosla joined their advisory board right after the acquisition.
Interesting. Signals confidence in that tech pivot. Okay, so the tech is advancing. What about physical expansion? New markets, big partnerships fueling the rollout.
Yeah, expansion seems relentless. They've moved into new major U.S. markets, Atlanta, for example.
Yeah.
And there are firm plans for a Chicago launch in December 2025.
Chicago in December. Ambitious timing.
They've also expanded their existing partnership on the Uber Eats platform. But the big headline grabber recently was the strategic deal with Little Caesars.
Little Caesars Pizza, okay.
Launching autonomous delivery with them in Los Angeles.
I saw that detail in the sources about the robots for Little Caesars. They can carry 4 large pizzas plus sides.
Yeah, 4 large, like 16-inch pizzas apparently, plus drinks and sides.
4 large pizzas. That's really scaling for the average family order. Makes you wonder about the design, the weight capacity.
It definitely speaks to customizing the platform for high-volume partners. And speaking of volume, the Q2 results seem to back up this momentum.
They did. Second quarter 2025 revenue was $642,000. That's up 46% from Q1.
And delivery volume growth was even faster, nearly 80% quarter over quarter.
So more robots, more deliveries, more revenue. The scaling seems to be translating directly.
It does. And if you connect all these dots, the scaling, the Little Caesars deal, the Q2 numbers, the Value AI, the overall market sentiment, especially among analysts covering this space, seems, well, overwhelmingly positive.
Okay, so let's talk stock price then. What are the professionals predicting? If SERV executes this plan, what's the potential upside look like?
The analyst consensus is a strong buy. The 12-month average price target is sitting at $17.75.
And where is the stock trading now, roughly?
Around $13.75 recently, so that average target implies, what, about 29% upside from current levels?
Okay, 29%. Decent. Any higher targets out there?
Oh, yeah. Some of the more bullish forecasts go as high as $23. That would be closer to 69% potential upside.
69%. That's significant. Now, what about the technical chart? Is the price action itself looking bullish, or is this all just based on future hopes?
No, the technical picture actually looks pretty robust right now. Bullish, I'd say. The stock is trading above both its 50-day and its 200-day simple moving averages.
Which are key trend indicators. Where are those averages sitting?
They've actually converged right around $11.17. So that level, $11.17, should act as a pretty strong floor of underlying support.
Okay, support at $11.17, price around $13.75. What about momentum? Is it looking overbought?
Momentum looks healthy, actually. The relative strength index, the RSI, is at 53.15.
Which is considered
neutral to maybe slightly bullish. It suggests the upward momentum is solid, but importantly, it's not in that overbought territory that often signals a pullback is due.
So room to run, potentially.
Potentially, yes. And the short-term trading channel patterns are forecasting upside into that analyst range, the $17.75 to $23, maybe by late 2025.
Okay, so what are the key events, the catalysts that you should be watching for in the next few months? What could actually push the stock towards those targets?
There are 3 main triggers coming up pretty soon. First is the Q3 2025 earnings report. That's due in November. Should show continued top-line growth.
Okay, Q3 earnings. What else?
Second, the big one, official confirmation that they've actually hit that 2,000 robot fleet target.
Right. That's expected by year-end.
December, yeah. And third, also expected in December, is the successful completion of the Chicago market launch. Hitting those milestones would be big validation points.
Makes sense. What about longer term, maybe more speculative stuff? Any buzz around that?
There's always market chatter with these kinds of stocks.
Yeah.
A lot of talk about M&A potential.
Meaning SERV could get bought out.
Yeah, that SERV Robotics could be an attractive acquisition target for a major logistics player, Or maybe one of the big food delivery companies like Uber Eats or DoorDash. If you want instant scaled autonomous fleet.
SERV looks like a prime candidate.
Exactly. There was also some speculation about international expansion. They did a pilot in the Middle East and maybe technology licensing opportunities, especially with that advanced AI they got from Vayu.
Okay, lots of potential upside. But we always need to balance that with the risks. This is still a growth company. What could go wrong?
Absolutely crucial. The number one risk remains those operational losses. They're not profitable. That $183 million in cash sounds like a lot, but...
But the burn rate matters. Investors need to watch that closely, make sure it's actually leading towards profitability, like that $1 delivery goal, not just burning cash indefinitely.
Precisely. And their whole growth story really depends on nailing the operational scaling and getting broad market acceptance.
Right. You need cities to allow these things on the sidewalks, and you need customers to actually use them.
Exactly. If regulations in new cities, like Chicago, slow things down, or if consumers in those markets are hesitant, that explosive revenue growth could cool off fast.
Are they acknowledging these risks?
Management seems aware, yeah. The sources say they're focused on aggressive R&D, presumably to improve efficiency, and also on cost discipline.
Okay. One more thing before we wrap the risks. The sources mentioned some insider activity.
Yes. Important to note. We did see some insider selling by the CEO back on September 8th.
How much?
It was about 164,735 shares, sold at an average price of $10.33.
$10.33. The stock is significantly higher now.
It is. But, insider selling is always a data point critical investors track, especially during such a high growth phase. Doesn't necessarily mean anything negative long term, but it's information.
Definitely something to be aware of. Okay, so let's pull it all together. What does this mean for you, the listener? We've seen, frankly, breakthrough revenue growth, really strong operational execution towards that 2,000 robot goal, clear catalysts coming up soon, and a technical chart that looks supportive.
Yeah, putting it all together, the overall investment thesis, based on synthesizing all this data, comes out as a strong bullish rating. We scored it an 8.5 out of 10.
An 8.5, pretty high conviction.
It seems attractive for potentially two types of investors. Short-term traders might play those upcoming catalysts earnings, the 2,000 robot number, Chicago launch.
Long-term investors.
And long-term investors might look at it as a way to capture market share in the really significant structural growth expected in autonomous delivery robotics over the next few years.
Okay, so we've analyzed SERV Robotics pretty thoroughly, focused on that ambitious 2,000 robot target, the strategic push towards that $1 per delivery cost using advanced AI.
It's a compelling story if they execute.
It really is. And as you think about all this, here's a final question for you to ponder. If SERV Robotics, and maybe its competitors too, actually succeed in scaling these fleets and hitting that transformative $1 per delivery cost, how drastically and maybe how quickly will the entire logistics and delivery industry shift?
And what happens then? What's the societal impact on that huge human delivery workforce we rely on globally?
That's a massive question to think about as this tech moves from, planning and pilots into full-scale reality.
Indeed. A fascinating consequence to watch unfold.
Well, thank you for joining us for this analysis. We look forward to seeing you for the next one.
Thanks for listening.